My name is Glenn Eunice. I do some stuff with Jason and Chris. So we're going to bring on Brian LePage from Bay Bank. Brian was recommended by one of the founders of this meetup group, Ian Horowitz, who's in the back doing business as usual. But Bay Bank is a local bank who's doing a lot with real estate investors. So without further ado, Brian from Bay Bank is going to explain a little bit about he and his bank, and then I'm going to poke and prod with questions, and you guys will also ask questions as well. So this portion of it's going to be very interactive, very fun. Lucky enough, Jason and Chris are my childhood best friends, so I always like to come here. I own a few rental properties myself, so I am a lay expert, if you will. So if you have any questions, I can help field them. Probably equipped to do that, but Brian from Bay Bank will explain his bank and himself, and then again, very interactive, and we'll get right into it.
Thanks, Glenn. Thanks for having me, everybody. Appreciate your time tonight. Show of hands of who's heard of Bay Bank. All right, we got a couple of people. That's more than I thought. We're not a terribly old bank, and I'll get into that reason, but I'll get first here a little bit about myself. Been in banking since 2002. Been in a number of roles in banking, starting with retail, call center. I worked my way out of the call center into the branches, running branches, opening branches, starting new lines of business, small business underwriting, to where I'm currently on as a commercial lender. So the way that Bay Bank looks at investor-owned residential real estate, and you'll hear me throw out this acronym IORR, and that's investor-owned residential real estate. We look at this as a commercial entity. We look at these properties as their own little businesses to support the credit that they have. And that's kind of the approach that we've taken at Bay Bank about that. So a little bit more about Bay Bank. We're 6 years in the making, so we're not a terribly old bank. And what I mean by that is a private equity group got together about 2010 timeframe, formed a charter, and then bought the failed assets of Bay National Bank, which is how we got the name Bay Bank. Since then, we've acquired 3 other banks: Carrollton Bank, Slavi Bank, Hopkins Federal. All failed or failing banks are struggling to kind of continue to go on. So we've gotten pretty good at acquiring banks and acquiring portfolios that have heavy concentrations of IORR. And so we've developed a program around this just to try to develop and keep the properties in the hands of the investors at good LTVs and good amortization schedules, to where we feel that if the market does compress a little bit more, that we have some flexibility in that, and we're not calling loans or trying to pull them up. We're trying to create more loans to investors and do this in a pretty practical way. So we've developed quite a few different programs. There's about 3 different programs, and you got a handout here that kind of goes out over the 3 types of programs, what we look for as far as how we're going to qualify it. Bay Bank is a cash flow lender, so first and foremost, we got to have revenue. Got to have the cash flow in place. That's how we're going to get paid back. We always look to the cash flow of these properties, and like I said, this is a business. So if these are little businesses and these entities represent this business, how does it generate cash flow? And we're going to look at that, we're going to scrutinize that. And that's where we really put a lot of the analysis on, is understanding the cash flow for that. Now, whether it's market rate rents or you're doing any voucher programs, to us, as long as there's some consistency, there's stabilization, there's seasoning, we get comfortable with the borrowers, because this is a relationship. And we look at this as that. Now, how do we want to know your experience. We want to get to know our borrowers. We're not looking to do one deal and top it off. We're looking to keep putting money out on the street. That's the game plan. Develop relationships with people out there who know how to work in real estate, how to hit a budget, how to hit a timeline, how to turn these assets and to use these assets like a business. And that's really what we look at, kind of understand that. And that's kind of where all the mechanisms, as you're kind of reading through this stuff, some of it may or may not make sense, and I'm certainly open to dialogue. If you have questions along the way, throw up a hand. I'm happy to stop at any point and answer those questions. But Bay Bank, you know, our tagline is a bank built by entrepreneurs for entrepreneurs. So we look at these loans as our own business entities. Like the IORR program, that's my entity. So, you know, I got to get to know my borrowers and understand what it is that you guys have been able to do in the real estate world, and then kind of build from there.
You get into the part where you talked about each individual property is sort of its own entity, and you're lending as much necessarily on the property as you are on the customer. Talk about the credit versus the cash flow versus the LTV. Before we do that though, and this is, we did this last month with Mark Owens, our rental property expert. He has over 100 rental properties, and we got into some really interesting stuff. Somebody asked a question about 3 1s, and it dawned on me that I don't know if anyone knew what he was talking about, so I asked the question. So Chris brought up a few specifics, you brought up a few specifics. LTV. I know most people know what that means. If you don't know what LTV means, please raise your hand. Okay, 1, oh, okay, 2. Be honest, what do you know what LTV is? Who doesn't know what LTV is? We got 2 little stragglers. All right, LTV is loan to value, right?
Yep.
So the loan versus the value. And a hard money banker, as most people know in here, is going to try to be in that 65% range if somebody asks. A bank may be somewhere different. So as we're talking about the property being what you guys lend on, not necessarily the person, but definitely the bank looks at the person more than a hard money lender would, and the LTV. Add that all up, you know where I'm going.
Yeah.
Talk about it.
Yeah, so there's 2 fundamental points that we look at just to even get out of the gate. We're looking at an LTV of 70%. So to kind of hit at the loan to value, we're looking at it, now we're not looking at it from a cost standpoint, we're looking at it as a value standpoint. There is some difference there. But the first spot that we're looking at is a 70% loan to value. The second is going to be the cash flow perspective, and that's at a 1.15 debt coverage ratio. And I'm sure not everybody knows what a debt coverage ratio. Again, this is why we do this on the commercial side, is we're going to be looking at all the operating expenses that go into a property. And I'll boil it down to pretty simple measures. What a 1.15 debt coverage ratio means is that the property throws off more income, 15% more income than what the annualized debt is. So let's just say, for the sake of argument, the annual debt is $12,000, $1,000 a month. Well, then the property needs to have net income of $14,000. I mean, that's basically what we're looking at. This property has more cash flow coming in above what the principal and interest requirement would be for the bank debt. That's how we're going to qualify it. Those are our 2 starting points.
HOA, ground rent.
Operating expenses, we're going to be looking at taxes. We're going to be looking at insurance. If there are HOA fees, repair work, do you have a property management? How are you getting your tenants in there? Are you placing those tenants yourself, or are you hiring a company to do that? Those are expenses. That's operating the entity. We got to figure out what that is. And those operating expenses are going to take away from your net operating income. Now, there's other expenses out there that we can use and we could add back. Depreciation, amortization, interest expense. Those are all non-cash items, or non-cash accounting items, that we can add back, because those will be ultimately used to service the debt. That's just an accounting measurement. So there are different ways that we can get in there, and I might be getting a little too much in the weeds right now.
No, this is good.
But I mean, these are the types of things that, you know, we like to talk about is, you know, what does it take to operate this? The soft costs, how'd you get the loan? You know, these are all expenses for your business that you're going to have to take an account for in order to look at the profitability of this. And everyone likes to look at the end game and kind of what they're selling the property for, but all those soft costs and bank costs and finance costs, I mean, that's taken away from what that end game is.
No, I think the reason we want Brian here and all of our guests is we do want to get into some nitty gritty. And I'll just kind of buy some time here by explanation.
Yep.
But I see a lot of new faces, see some familiar faces too. Hi, by the way. And what we try to do with this meetup is provide really, really strong, free, awesome content for real estate investors. That's just period what it is. Last week, Mark Owens got into some real nitty-gritty stuff about rental properties. Brian's getting into really finer point details, but this is what you need to do, because if I just want to buy a house and pour some money into it and flip it and make some money and then, I don't know, get out of it, well, I mean, okay, yeah, and I want to dunk a ball, but I'm like 37 now, and I'm past that, you know? So I use a ladder, and it's smarter, and I can still put the ball through the net, you know? So, like, yes, you want to get private money. Yeah, you want to use Uncle Mortimer's cheap money. But ultimately, you want to do more of these, and you want to refi out, you want to get a long-term leverage for a rental property, you're going to need to figure out what in the heck Brian's talking about.
Yeah.
So that's why this nitty-gritty is so important, and to bring it all home, that's what we do this meetup group for, because, look, we're dorks. I mean, I own 4 properties, a lot of people in here own properties, which is going to lead to my question. I didn't know this when I bought my first property. I promise you I know it now. And there are people in here that have load shares of properties. You need to understand this so that you can keep doing it, so that it's long-term profitable, not, oh, I got lucky and I found a deal and the market's good and I sold it and I made 30 grand. Oh, awesome. Let's figure out a way to do that all the time, and that's what Brian's here for. So, with that said, how many people own a rental property now, or rental properties? That's what I'm talking about. And that's what makes this room a real deal room, and that's why we need, I don't know, debt service ratio 1 point. I mean, I don't know. I'm sitting here learning too.
Yeah.
I'm just like, okay, I take my rent and then divide it by 75% because that's what it sort of costs me to maintain it. And then like, can I get a loan? You know what I mean?
Yeah.
Obviously, I'm joking a little bit, but so
Yeah, Glenn, you bring up a great point. You know, it's, you know, who does a bank really want to work with? We want to work with repeat customers. The onesie, the twosies, you know, the kind of back of the truck, it's going to be difficult to qualify for bank financing, just being honest. We're going to have dollar thresholds to where, quite honestly, as one businessman to the other, I can't imagine that, you know, I'm going to sit across from you and be like, all right, we're going to do a loan for $70,000. Well, all my attorney-prepared documents, all my loan fees, my origination, now my interest rate is going to be cheaper than hard money. My point origination fee is cheaper than hard money, but I have other expenses to where, quite honestly, I don't know if the juice is worth the squeeze. And that's where, you know, you got to get over $100,000 minimally to really get, you know, because there is a lot of work for a bank to be able to put this together. Is there multiple properties? What are we looking to do here? How are we structuring this? Are they owned in an LLC? Again, like I began with, we're doing a commercial loan. This is an LLC. So these are documents that are going to be prepared by an attorney for the fact that you're going to have these real estate properties come in and out of these LLCs. The average hold period for an investment property is 5 years. So if you set up an LLC and you have properties coming and going like, I got a great deal, I got to sell this thing off. I don't know if I'm going to be able to get the money out of this property like I am, and plus I got another opportunity. We can move it in and out of loan docs with an attorney a lot easier than doing it with bank shelf docs. Because then we have to pretty much start over with shelf documents. Attorney prepared documents is, again, we do that in a way so it's repeat, and we can customize that, move the collateral out as freely as we can, and to be able to kind of keep the structure of the original deal in place. Now, it sounds nice, right? It sounds pretty easy, but there are some other moving pieces that we got to understand. You know, if you sell one property out, are we going to buy it down? You know, we can get lost in the weeds here pretty quickly, but, you know, ultimately what we're looking to do is, this is a commercial entity. This is the way that we view this. You know, we want to build this and kind of continue to grow with our borrowers, so we're doing 1 deal, 2 deal, 3 deals, 4 deals, etc. And we're kind of continuing to grow it in that way.
you underwrite per property.
Depends.
Or in bulk.
So, you know, let's get into some of the products that we offer here. And I think that, you know, when you're doing a loan, we're not going to do a cash out loan. If you're kind of coming in and saying, I got these 4 properties, I bought them, they're free and clear, I want to cash out, take my money out, and, you know, just put a new loan on there. You know, we're not your piggy bank. I don't think it's going to work that way. Now, there is a product that we can do, and I'll get to that. But if you have properties that you're looking to buy and hold, that we're looking to acquire, you know, the first product is, you're kind of looking at the sheet here, is just your basic refinance or purchase acquisition loan. And that's going to be at a 70% LTV of the acquisition price, and then we're going to put a 5-year fixed rate, 20-year amortization. These interest rates aren't fixed for longer than 5 years. It's a commercial loan. We revisit our businesses. All of our commercial loans are done in 3-year, 5-year, 7-year increments. Because you look at a business 7 years from now, that's a long time for a business to operate without revisiting that credit.
You and the borrower flexibility.
Correct. Yeah, not to say that we're ever going to fall out of love, but potentially in 5 years from now, you're like, this wasn't that great. I want to get out. It allows you to do that. But again, it's going to really, we look at this again like a commercial entity. We got to know that this property has been through some vacancies. You've done what you need to do to stabilize it. You're going to have to put repairs in it. You're going to see these tenants come in and out. We're going to kind of understand what your portfolio is doing, and we can kind of come to some pretty conclusive evidence to what we're doing. So really, the first one is just kind of your turnkey, buying this property. It's stabilized, the rent supports the credit. We got what we call permanent financing on there, 5-year fixed rate, 20-year amortization. Second is going to be your flip. Or even if a purchase, renovate, and then place into permanent financing. Basically, the product's the same. It's a 9-month loan, interest only. We're going to fund 70% of the acquisition, and then we're also going to fund 70% of the as-repaired value. So on that as-repaired value is how you're really going to get the rest of your equity out on the property. So what I mean by this, and I'll just use this kind of as blank examples, property's worth $100,000. We're going to do a loan for $70,000. At the end of the renovations, it's worth $150,000.
That's what you're basing that 9 months on. You got 9 months to get that property right.
Correct. So at the end of, and again, as we're going into the loan transaction, I want to do this in one settlement. I don't want to settle twice on this and double the finance costs. So I want to have the budget, the plans, the specs, your contractor. I want all that information up front because I'm going to give that to the appraiser, and they're going to do that as renovated value. So then the 150, 70% of that is 105. Our loan is for $70,000. Your equity in is $30,000. The as renovated value is 105 that I can lend on. If you're doing this right, you should be able to repair that property with $35,000 and you're not out of pocket for the rest of the funds. We're financing 100% of the construction draws through a construction draw schedule. So that's
At
just...
the end of the day, property's worth $150.
$150. Yep. So whether or not you're going to flip it or put it into permanent financing, how we do at the end of that 9 months is we either put it into permanent financing or we get paid off when you sell the property. Either way, it's still going to be a 9-month time frame. So the third one I kind of alluded to a little bit before when I was talking about how we're not going to be your piggy bank, how we're not going to just kind of cash out on a loan. What we can do is put a line of credit on it. And we're going to utilize that line of credit in a way that allows you to acquire more investor properties. So what that means is, again, I'll just use the same example, a $100,000 property that you own free and clear. We stick a $70,000 line of credit on there, and you're able to use those funds as you see fit. As soon as you advance it, just know there's a 12-month timetable put on that. At the end of 12 months, the expectation is that you've acquired a property, you've renovated a property, you've stabilized it, and we're ready to term it out. Take that $70,000, the new property value, I'm just using blank examples here, is worth $100,000. That $70,000 goes into a new term loan. That $70,000 then goes back onto the line of credit, and it's ready for your next project. So I'm not cashing you out, but I'm giving you a mechanism and a way to utilize your equity that you've already built into these properties to build your portfolio. In the back.
You give it 20%?
50%.
So you go 50% on this, 7% of equity. There's a lot of pressure on the 20%.
No, it's for properties that are owned free and clear. We're not going to be able to do, we're not going to go into a second lien position. We're not going to take a junior position on any of that. It's going to be first lien only on that one. Yes, sir.
All right, so my question would be, what difference will it make if I use my own money, buy it, flip it out, not come to y'all for cash out versus you giving us the money up front? One way or another, you have a property that's worth the same amount of money and it's the same term. What would be the difference from your lending perspective?
So let me just make sure I got the question right. So you're saying that you have cash to be able to make the acquisition, renovations, improvements, and sell off, and you want to see what the difference would be in using bank financing?
Well, you made the statement of you're not going to be someone's piggy bank, right?
Yep.
So if I just will use, I have 4 properties that are worth $100,000 each that I own free and clear.
Yep.
Versus just say, the people to my right, they want to do the same exact thing. They want to buy 4 properties. If I already own mine, you're saying that you wouldn't give me the money, the $7,000.
Not in a loan. I'll give it to you in a line of credit.
But you would give it to them. So I'm asking for.
I wouldn't give $400,000 to them. I'd give them a 70% loan for the acquisition of those 4 properties.
Well, the point I'm making is that it's the same no matter.
It's a line of credit for acquisition of more rental properties. Their bank
Yeah.
their bank is trying to be a rental property or a rental real estate specific bank.
It's the same exact thing.
I get it. I get what you're saying, but like to fight a bank's guidelines for how they raise their money, who cares?
I'm asking.
No, I'm just saying like the money.
asking from their lending perspective, what's the.
Because they don't want you to take money out and buy whatever. They want you to take money out specifically on a line for a period of time to buy a property.
Collateralize the property.
Correct.
Yeah,
It's
so
just the way
to
they-
cash out on a loan, I can't tell you how to use those funds to cash that out.
I get it.
Yeah,
sure.
so for the line of credit, all advances are going to be used for the acquisition of more real estate and building your portfolio. So, I mean, if you're looking to, in that example, your equity would still come in at a 30% for the acquisition of those prices, and you'd have a term debt. It'd just be structured a little bit differently.
Correct me if I'm wrong, that you guys want to be in the real estate game, and you want to direct the people that you do business with in that game as well, if they want to, and if they don't, whatever.
Yeah, we want to deal with the people that know how to acquire the properties.
Whatever.
Yeah, there's not a lot of them, and that was, and again, kind of, we spoke a little bit about it before when I talked about some of the predecessor banks. Why they failed is that people were doing these cash outs to support other failing projects, and there wasn't that global income and that global analysis. So there is, we're really kind of talking simplistically about this, but ultimately, to do the cash out refinance to use for another project, that's where a lot of banks got caught, because projects started going sideways and the money just started kind of getting pulled out, and all the collateral that actually had some equity and that was performing.
Got 2 questions over here, the gentleman here, and then this lady here.
Question, you said that the line of credit goes for 12 months. What happens if that project has sold?
The question is, what happens after 12 months if you haven't gotten rid of that?
Property doesn't get sold, then we will term out on the properties that you already pledged for the line of credit. So that advance would then get termed out. So then the line of credit basically goes away. So let's just say that you use the line of credit, you have a $100,000 line of credit, you had bought 2 properties on there, properties aren't renovated, they're not stabilized. Well, we already have the other properties that created the line of credit, that secured that. We take that advance, we term it out on these properties, and then you're left to kind of deal with those properties on that side. So the properties that are stabilized and they're creating revenue, those are the ones that qualify the ability to have a line of credit.
So I understand that debt service analysis, like most banks want to qualify the borrower. Do you have like a qualification?
Sure do. Yep. So outside of the primary qualifiers for the properties and the loan to value and the 1.15, we have a global, and the global debt coverage is 1.25 that we look at that. We're going to look at the borrower's expenses, what their credit report says. We're going to look at the revenue outside of these properties. We're going to take into consideration living expenses and some other analysis that we make sure that these properties aren't supporting a lifestyle, that they have some other source of revenue or ancillary revenue to be able to support that. 680 is the minimum credit score. Personal guarantees, everything comes full recourse.
One last question.
Please.
I see the rates at 5.25 to 5.5, and then you talked about fees.
Yep.
Are there points associated?
1 point origination.
That's it.
And so, correct.
On either a flip or
Yeah, so the rates are going to be the same from product to product. We don't look at this whether you do it with a buy and hold, line of credit, a flip. It's ultimately investor-owned residential real estate. It's IORR. So we price this on a spread margin over the 5-year treasury, because we're qualifying your debt coverage and the property's debt coverage on that 5-year fixed rate, 20-year amortization. Because ultimately, if everything goes bad, and not to say that it will, but that's going to be the way that we're going to term this out. And so we're qualifying everything on that 5-year fixed rate, 20-year am. So that's part of how we're also going to get to that dollar amount, that loan amount. So even though the loan to value might be, you might have more equity, but the property only supports, let's call it a 50% loan to value. Well, that's going to change that loan amount. And those are going to be the secondary things that we're going to be looking for. Does that answer your question?
Yeah.
Okay.
I want to take you in the back, and you still have your question up front, but I want to put a thought in your head to think
Please.
about, because as we're taking questions, I'm learning what you guys do too. You gave the 3 sort of different packages, right?
Yep.
Not now, because we're going to take up questions, but just, I want you to sort of build that timeline of a consistent real estate investor who comes and does their one deal with you, turns it in another, and sort of that timeline of how they'll use all 3 of your different programs. Because I think that will help explain and paint the picture in everybody's mind's eye of how a real estate investor goes from 1 deal to 2 to 3 to 5 over that period of time, okay?
Yeah.
So don't do that now.
Okay.
Just think on that. I know you don't need to, but
Okay.
you kind of need to.
No
Yes,
problem.
ma'am, and then we'll get you in the back. Question.
I was looking at the qualifiers and 3 years of an LLC tax return. Is that strict or?
The question is about an LLC, and you need 3 years tax returns for qualifications.
So it's not hard and fast. Again, it's going to speak to, if you look down as well, we're going to want to see your real estate background. What's your involvement?
It's personal, maybe not LLC.
So if it's personal and you can show your history to be able to perform on projects, that's going to be one of the ways that we can kind of work within the box. Granted, would we like 3 years financial performance to kind of analyze and get comfortable with? Yes. But if you have a history of doing it with somebody else and now you're going on to your own and you can kind of provide that backstory and show that, then we're going to be able to kind of rely upon that. Again, for bank financing, the difference, one of the main differences is really just knowing that, have you handled an asset like this? Have you been able to hit that budget, turn it, flip it, get rid of it, or hold on to it and manage it properly? The last thing the bank wants to do is to own the property itself. We're in the real estate game, but we're not in the owning of real estate. We want you to do that, and that's where we got to get comfortable with the thought process on that.
So I wouldn't be me if I didn't say that. Full disclosure, I do not work for Hard Money Bankers, my best friend's company. I'm someone who does some mic work, so I can come up here and sort of not embarrass myself in the company. But I would say what we're learning here is maybe the value of a private lender or a hard money lender to start. And when you grow up, I don't know that I could qualify to get what you guys are giving. You guys are a big boy bank, and a bank has certain guidelines. And for some people, it's amazing, and it's great, cheap money. For some people, we can't get to you.
Yeah.
And there are other people that can get you started to get to Brian or a bank or what have you. And I'm not selling Hard Money Bankers or not selling the bank or whatever. That's what it is. I'm putting the pieces together now. I met Brian 10 minutes ago.
Correct.
Yeah,
no, glad you make a great point. I mean, it's, how we get there, is, again, we're looking at this from experience and the cash flow and the different things like that. So if you don't have historical cash flow, bankers in general, we're historians. We look back in order to make our credit decisions going forward. So, we're going to look historically at what you've been able to produce individually, be able to look at what this property has produced. Has it been rented before? Is the tenant staying on? Are you looking to place these tenants? If some of these pieces have some gaps, it's going to be hard for us to get comfortable with that. Again, it's primarily bank financing. We're FDIC regulated, so in that standpoint, we have a lot more underwriting and kind of stringent things that we have to adhere to in order to be able to qualify these debts.
in the back.
Okay, I just want to make sure I'm kind of here to make sure, saying commercial looks at loan based on income. Okay. You go looking at tax returns, the tax returns are not going to reflect income, but bank statements, cash flow, and all those things can be documented. So how are we doing it? Because those two are juxtaposed to each other. You can't have high tax returns. You're not going to be in this business and not write off everything. But you can show cash flow through a bank statement. So how are we doing? Because
we don't qualify cash flow through a bank statement. We adhere to tax returns. So Uncle Sam is who he have to show.
before deduction, before depreciation and stuff like that.
We add back depreciation and amortization. If you recall back, there are some add backs that we do. So there are certain things that we'll add back that are non-cash events, like depreciation, amortization, and that we'll add that back. But again, we're, on the commercial side, it is revenue driven, and it is based on what the tax returns show. Now, the property is going to have its own lease.
From the property.
Well, again, these are going to be done in LLCs. And whether they're on their Schedule E, on your personal income side, if it's a single member LLC, you can show them on your Schedule E, and we can do it that way, and we can look at the expenses, and we can say, all right, it's a single member LLC, it's on his personal tax returns, we can show the revenue that you're claiming through Uncle Sam. I gotta be able to base my decision on what shows for the IRS, because we're federally regulated.
Well, you also made an interesting point. One is the LLC piece, which I want you to get into. You also made an interesting point about some of the reasons you scrub personal tax returns is because if somebody is living off of the income of the rental properties, that has to be factored in to the debt ratio that you service.
Correct.
Because if they then get a loan, which increases the cost of that property, but they're living on 80% of the cash flow from that property, they might not have the ability to repay like they would otherwise show.
Correct.
Is that what you're getting at?
Yeah, so that kind of goes into the 1.25 debt coverage ratio that we're going to take into consideration. 680 minimum credit score, we pull your personal credit. We're going to look at what you're obligated to pay according to the credit report. We're going to look at the other revenue outside of the property to be able to show how that's being supported. And then based on that is how we're going to be able to qualify this loan. So there's a couple of levels of qualification. It's not necessarily that the property itself supports the entire credit. There's other aspects. That's where it starts. But there's some other supporting information that we need to be able to show that this property isn't going to take out the borrower. Last thing we want to do is have it take out the borrower and become too much of a debt burden, and it pulls the rest of it down. Does that make sense? You can see a lot of not shaking heads, so I'm assuming that it doesn't make sense. Basically what we're looking for is if you have, and here's what we're looking for. If you want to kind of get a pull behind the curtain, if you will, we look at living expenses, and right off the top on your personal W-2 income outside of your, if you have other business income and other things like that, $25,000 or $24,000, $2,000 a month towards living expenses. You got to pay cable, got to pay your utilities. There's other, fundamental aspects that you're going to be funding that we understand from a banking standpoint that needs to be accounted for. These are all living expenses. So those are taken out on the personal revenue side. So again, there's layers of qualifying that happen. First starts with the property, then we go into the individual and the ownership.
Let me ask you this question. How, I don't think that, my guess would be is you guys aren't lending money in a vacuum and then doing a product or selling products or offering products to real estate investors that nobody else in the banking world is doing. So with that sort of undertone, how unique or rare is what, I guess what I'm saying is, the vibe, look, I'm just going to be real. The vibe I'm getting in the room a little bit is like people don't understand what you're selling, and I think what I'm asking you is, isn't this sort of standard in this business? I'm not saying that you can go knock on any bank's door and be like, yo, I need a real estate loan. It's the same as Brian's. Of course you're different, and we'll get into, we've gotten into what differentiates you, and you guys are experts. But like, you're not changing the wheel. You haven't reinvented the wheel in the real estate.
No, we're not doing anything that any other bank isn't already doing. The difference that we're doing is probably the line of credit piece. Not a lot of banks offer a revolving line of credit to be able to use to acquire more real estate. That is pretty unique. But as far as the other qualifiers, that's industry standard. There's really not much too different that we're doing that any other bank isn't going to be doing.
Any other questions? You guys got it? Cool.
I feel like I've thoroughly depressed everybody. You're very welcome. Glad I can play my part in this. Thank you.
Guys, thank you very much. Brian, well done.
Thanks, Glenn.
All right, guys, that'll do it for this meetup. Chris is somewhere roaming. Jason's back there as well. I would encourage you guys to chat with them. Thank you very much for coming. See you next month.